Revenue forecasting is an essential practice for any business aiming for financial stability and growth. It involves estimating future income over a specific period based on historical data, market trends, and strategic insights. Accurate revenue forecasting helps businesses set realistic goals, allocate resources efficiently, and identify potential challenges in advance. For entrepreneurs, mastering revenue forecasting techniques is critical for building a strong financial foundation and ensuring long-term sustainability. This module, Techniques for Revenue Forecasting, in the Financial Planning for Entrepreneurs, Build Your Dream course, explores practical methods for predicting revenue and making data-driven decisions. What is revenue forecasting? Revenue forecasting is the process of predicting how much money a business will generate within a given time frame. This can include monthly, quarterly, or annual forecasts, depending on the business's needs. Forecasts are used to plan budgets, guide investments, and set realistic expectations for growth. Why is revenue forecasting important? 1. Strategic planning helps in setting goals, defining strategies, and prioritizing initiatives. 2. Resource allocation ensures efficient use of resources by predicting cash flow. 3. Risk management identifies potential financial gaps and allows businesses to plan contingencies. 4. Investor confidence accurate forecasts build trust with investors and stakeholders. Key techniques for revenue forecasting. 1. Historical data analysis analyzing past revenue trends is one of the most reliable methods for forecasting. By examining historical data, businesses can identify patterns and predict future performance. Steps to analyze historical data. 1. Gather revenue data for at least the past 12 months. 2. Identify seasonal trends, such as higher sales during holidays. 3. Account for anomalies, such as spikes due to one-time events or promotions. Example, if a clothing retailer consistently sees a 20% increase in revenue during winter, they can use this pattern to forecast revenue for the upcoming winter season. 2. Market research and trend analysis understanding current market conditions and industry trends provides valuable insights into future revenue potential. This technique involves analyzing factors such as customer behavior, competitor performance, and economic indicators. How to conduct market research. 1. Study industry reports and market trends. 2. Analyze customer preferences and buying habits. 3. Monitor competitor strategies and pricing. Example, a business operating in the tech industry can use trends like the growing demand for artificial intelligence tools to predict increased revenue from related products or services. 3. Sales funnel analysis revenue forecasting can be based on analyzing your sales funnel, which tracks the customer journey from lead generation to conversion. This method uses conversion rates at each stage of the funnel to estimate future revenue. Steps to use sales funnel analysis. 1. Identify the number of leads generated during a specific period. 2. Calculate conversion rates for each stage of the sales funnel. 3. Multiply the number of leads by the average transaction value to estimate revenue. Example, if a business generates 1,000 leads monthly, with a 10% conversion rate and an average order value of 5,000 rupees, the forecasted revenue is 500,000 rupees, 1,000 times 10% times 5,000 rupees. 4. Bottom-up forecasting. Bottom-up forecasting involves starting with granular data, such as individual product sales or customer transactions, and building up to a total revenue estimate. How to use bottom-up forecasting. 1. Estimate the number of units sold for each product or service. 2. Multiply by the price per unit to calculate revenue for each category. 3. Sum the revenue from all categories to get the total forecast. Example, a coffee shop forecasts selling 5,000 cups of coffee monthly at 100 rupees each, generating 500,000 rupees in revenue. Adding revenue from other items like pastries or sandwiches provides a complete forecast. 5. Top-down forecasting. Top-down forecasting starts with a broader market size and narrows down to estimate the business's share of the market. This approach is useful for new businesses or when entering a new market. Steps for top-down forecasting. 1. Determine the total market size, for example, 500 crore rupees industry. 2. Estimate your market share based on competitive analysis, for example, 1% share. 3. Multiply the market size by your expected share to calculate revenue. Example, if a business targets a 500 crore market and expects a 1% share, the forecasted revenue is 5 crore, 500 crore rupees times 1%. 6. Scenario planning. Scenario planning involves creating multiple revenue projections based on different assumptions, such as best case, worst case, and most likely scenarios. This approach prepares businesses for uncertainties. How to use scenario planning. 1. Create different scenarios with varying assumptions about sales growth, customer retention, and market conditions. 2. Develop revenue forecasts for each scenario. 3. Use these forecasts to plan budgets and contingencies. Example, a business might forecast revenue growth of 20% in the best case scenario, 10% in the most likely scenario, and 0% in the worst case scenario. 7. Subscription-based forecasting. For businesses with subscription models, revenue forecasting can be based on metrics like customer acquisition, churn rate, and average subscription value. Steps for subscription forecasting. 1. Calculate the number of active subscribers. 2. Factor in the average revenue per user, ARPU. 3. Adjust for expected churn or new customer acquisition. Example, if a SaaS company has 1,000 subscribers paying 1,000 rupees per month, the forecasted monthly revenue is 1 million rupees. Accounting for a 5% churn rate, the revenue decreases by 50,000 rupees in the following month. Best practices for revenue forecasting. 1. Use multiple techniques. Combining methods like historical analysis and market research ensures more accurate forecasts. 2. Review regularly. Update forecasts frequently to reflect changes in market conditions, customer behavior, or operational performance. 3. Focus on accuracy. Avoid overly optimistic or pessimistic estimates. Rely on data-driven predictions. 4. Engage stakeholders. Collaborate with team members, such as sales and marketing, to gather accurate data and insights. Benefits of revenue forecasting. 1. Improved decision-making. Accurate forecasts enable better planning for inventory, staffing, and marketing. 2. Financial stability. Predicting cash flow ensures that businesses can meet their obligations and invest wisely. 3. Enhanced growth opportunities. Revenue forecasts provide a foundation for strategic investments in expansion, innovation, or new markets. Revenue forecasting is a vital skill for entrepreneurs to ensure financial stability and drive business success. By leveraging techniques like historical analysis, market research, sales funnel evaluation, and scenario planning, businesses can make informed decisions and prepare for future challenges. The Financial Planning for Entrepreneurs, Build Your Dream course equips participants with the tools and strategies to create accurate revenue forecasts and unlock growth opportunities. Start forecasting smarter today to build a stronger financial future.